Today we're going to continue with Chapter 9. We're going to revisit the audit risk model, which we covered briefly earlier in the quarter. Acceptable audit risk equal inherent risk times control risk times plan detection risk. We combine inherent risk and control risk and refer to it as RoMM, risk of material misstatement. I have always just set inherent risk equal to 1. I understand what inherent risk is, but since it's inherently risky, nobody can control it. I just set it to 1. Think about the current coronavirus. Can anybody control it? No. Does it change the risk of many, many businesses? Yes. Now the book rearranges this formula and calls it plan detection risk equal acceptable audit risk over inherent risk times control risk. Since I treat inherent risk as 1, effectively it becomes audit risk divided by control risk. Notice the inverse relationship. Our audit takes on a sequence. Plan detection risk becomes a function of control risk. Okay. So if we think of audit risk as a constant set by auditing standards, then we see that plan detection risk, we don't know what that is until we figure out what our control risk is. Auditors can perform substantive tests to reduce detection risk. Auditors cannot reduce control risk. We don't test controls to reduce control risk. We perform tests of controls to see if our assessment of control risk is accurate. The more test of controls we perform, the more confident we become that our assessment of control risk is in fact accurate. Here's a little visual. If it helps, great. If it doesn't, that's okay too. Inherent risk is environmental. Test a control risk the client has control over. Detection risk the auditor controls. RoMM is a combination of inherent risk and control risk. Typically, when we're assessing control risk, we perform test of controls. Not always, but usually when we're assessing control risk, we perform test of controls. Detection risk, the auditor can reduce by performing substantive tests. The 3 types of substantive tests the auditor uses are substantive test of transactions, substantive analytical procedures, and test of details of account balances. Now notice the little purple or lavender section, transactions, bridge control risk and a portion of detection risk. Typically when we're testing transactions, we're testing controls, but not always. If you completed the vouch and trace project, you performed substantive test of transactions. You were trying to determine whether the sales was recorded correctly in the vouch and trace project, and you did that by testing transactions. A little outline of the audit. Why did Ted emphasize 315, 500, and 700 so much? Well, because after we obtain the client engagement, we have to first understand the client. That's 315. We do that by performing analytical procedures, studying the internal controls, gaining an understanding of the internal controls, and risk assessment procedures. Then we need to perform tests, obtain evidence, and that's 500. Test of controls and substantive test of transactions, analytical procedures, and test of details of account balances are tests that we perform to obtain evidence to satisfy 500. And then when we're all done, we issue the audit report. Control risk and plan detection risk have an inverse relationship. beat that into your head. That's going to come back and back and back. If control risk is low, if we want to assess control risk as low, then we're going to need to obtain evidence showing that the controls are in fact effective. We perform tested controls to obtain evidence that the controls are effective. If we assess control risk as low, then we need evidence that the controls are in fact effective. If control risk is low, it's okay for plan detection risk to remain high. If control risk is high, plan detection risk must be reduced to a low level. Notice the okay and the must. If control risk is low, it's okay for plan detection risk to remain high. We could reduce detection risk to a low level. It'd be very costly to do both, but the okay, it's not required for plan detection risk to remain high. Okay, it's okay for it to remain high. However, if control risk is high, plan detection risk must be reduced to a low level. We perform substantive procedures to reduce detection risk to a low level. Those are our three types of substantive procedures. If plan detection risk is high, we can limit the extent of our substantive testing. If plan detection risk is low, we need to perform extensive substantive procedures. Now, I want you to learn the words of the profession, limit and extensive. We could say we can do fewer substantive procedures. We could perform less, but we don't. We say we can limit. Okay, because we believe their controls are effective, we can limit our substantive testing. If plan detection risk is low, then we need to perform extensive substantive procedures. We don't say more, we don't say a lot. So let's learn the words of the profession, limit and extensive. Control risk is the risk that a misstatement could occur in an assertion about a classic transaction, account balance, or disclosure that could be material, will not be prevented or detected and corrected by the internal controls. So let's think for a minute that a material misstatement could occur. Not that it will occur, not that it did occur, but it could occur. So control risk implies that it could occur. Wherever I see the word assertion, I think transaction, balances, and disclosures. Will not be prevented or detected and corrected. So if an error is prevented, we don't need to correct it. If an error is detected, it must be corrected. So I'm a stickler for the or and the and. Now, control risk, I want you to learn virtually word for word. Detection risk, not so much. Detection risk is the risk that the audit evidence will fail to detect misstatements. I don't care. The audit evidence fails to detect misstatement. The auditor fails to detect misstatements. The audit procedures fail to detect misstatements. I just want to know that you know that detection risk is in the wheelhouse of the auditor. The profession's definition of detection risk is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a material misstatement. Okay, again, I don't care. I just want you to know that it's the auditor, the audit procedures, the audit evidence fails to detect a material misstatement. So control risk, word for word. Detection risk, not so much. If we assess control risk as low, then plan detection risk can be high, that inverse relationship. If we assess control risk as high, then plan detection risk must be low. either control risk or plan detection risk must be low. One of them must be low in our world. In the real world, there's a medium. You could have control risk as moderate and plan detection risk as moderate. We're going to just play with the extremes. We're going to say one of them has to be low. My belief is if you get a handle on the extremes, control risk is high, detection risk is low, or vice versa, then you can fill in the middle once you get your understanding down pat. If we preliminarily assess control risk as high, we're saying we don't believe their controls are effective. We don't believe their controls would prevent errors or detect and correct errors. If we preliminarily assess control risk as low, we're saying we believe their controls are effective. We believe their controls would either prevent errors or detect and correct errors. Now notice preliminarily assess. If there's a preliminary assessment, then you know there's going to be a final assessment somewhere later on. If we preliminarily assess control risk as low, we need tests of controls that provide evidence that their controls either would prevent errors or would detect and correct errors. So if we preliminarily assess control risk as low, then we need to perform test of controls. If plan detection risk is high, that implies that we preliminarily assess control risk as low because we believe their controls are effective. If plan detection risk is low, that implies we assess control risk as high because we don't believe their controls are effective. With regard to internal controls, we're going to call them effective or ineffective. We're not going to say good, we're not going to say tall, we're not going to say short, we're going to say effective or ineffective. Here's a little chart. On the left-hand side, you're going to see various significant classes of transactions. I hope you'd all agree that those are significant: payroll, cash disbursement, purchasing. Those are all significant. All we're going to focus on in this course are the top two: credit sales and collections, revenue and collection. Across the top, we've got our assertions. We have to preliminarily assess control risk for each and every assertion. Remember, we're going to use our assertions to form objectives. In our world, the assertions are the objectives. We're just going to tweak them a little bit to make them specific. The assertions are generic for all transactions. We're going to tweak them a little bit to make them apply to credit sales transactions. So since there are objectives, we're going to have to assess control risk for each and every assertion. Now notice that for occurrence, completeness, accuracy, for everything except cutoff, we're preliminarily assessing control risk as low. We're saying we believe their controls are effective. For cutoff, we're saying they're ineffective. That's pretty typical for small businesses to have ineffective controls over cutoff. Now, we take the assertions, and now we're just talking about credit sales transactions, one significant class of transaction. And down the left-hand side, we've got the various assertions, objectives, if you will. And auditing standards say whenever we assess control risk as anything less than maximum, then we're going to have to identify control activities related to the assertion, test of controls, and evaluate the results. So what does occurrence imply about a sale? I think occurrence applies that the customer ordered a good, that we delivered the good, that we billed the customer. So what would be a control activity? Well, this customer has a control activity that they won't enter a transaction in the sales journal unless there's an invoice. They won't create an invoice unless there's a corresponding shipping document showing that they ship goods to the customer. They won't create a shipping document unless there's a corresponding sales order showing that the customer ordered it with an authorized purchase order. How could we test that? Well, we could take a sample of however many, 10 transactions in the sales journal, and make sure there's a corresponding invoice, corresponding shipping document, corresponding sales order. Then we'd evaluate the results. Well, we took a sample of 10 and all 10 showed that they complied with the controls. Completeness. What's completeness imply? Well, completeness implies that every transaction, every sale got recorded. So I might say, oh gosh, I want to make sure the control activity is that there's an invoice for every shipping document and an entry in the sales journal for every shipping document. So we should have the same number of shipping documents as we have invoices, as we have entries in the sales journal. That's going to require some reconciliation because maybe not everything got shipped on the same order. How are we going to test that? Well, we're going to observe them performing the procedure, going to test their reconciliation. Okay, so each and every time we assess control risk is low for an assertion, we have to identify specific control activities, test those control activities, and evaluate the results. So it gets complicated. Tomorrow, we're going to cover some conditions that result in high risk. Thank you.